So I'd like to introduce Representative Brandy Donaghy of Washington State. She's going to start with an opening remark, and then I'll follow on with her after that, and then we'll do the panel discussion. So welcome to the Resilience Working Group meeting and session.
Okay. So I can see my papers with these, but I can't see you. So we're going to try to balance it here. So my name's Brandy Donaghy. I'm a state representative in Washington in Snohomish County. I live about 25 miles north of Seattle. I'm actually really excited that we've got this group together. And so while we're having a regular session, it's also going to be a bit of a meeting for our first meeting of the group to try to get things going so we can start working towards our goals. In my district, we face a bunch of different types of hazards from wildfires to landslides, which our train system can share because too often Amtrak is shut down by landslides. We have a major earthquake coming. We see a lot of flooding. We also face wildfires, and we're finding that a lot of areas that maybe didn't have some of those risks are having them more now. We're seeing them more often, and sometimes we're seeing multiples at once, and that is a problem. So our goal is to understand the risks of our communities, to reduce those vulnerabilities using planning, design, construction, building codes, and look for financial, insurance, and policy tools that'll help us protect our communities, make them more resilient so that when disasters strike, we can recover. Unfortunately, what happens very often is that we are so focused on responding to something that's happened, and we don't take the time to prepare for the possibility. There's always a crisis, and that crisis takes our focus away from things that could be coming later. To me, it's kind of like insurance, right? You have insurance just in case something happens. Building resiliency is the same thing. It's building that insurance so that when something happens, because we know eventually that it will, we're in a better position to be able to address it. So the working group, we want to identify those practical steps we can take to reduce risks. We want to identify things we can do to improve safety. We also want to be able to protect our economic stability, because if we can't do that, we can't maintain those resilient communities. And over time, to build communities that bend instead of break and recover more quickly and more effectively with fewer lives lost. So please think about whatever your capacity here is, what you might be able to bring to the table to help us identify spaces where we may be missing something. And thanks for being here. I'm going to let Lionel introduce himself. And be prepared for some resilience fun. Okay, I just geeked out.
Well, thank you, Representative Donaghy. I'm excited to really working as co-chair with this working group, and I'm a structural engineer, also a sustainability consultant. I've been doing that all of my career. I focus around building codes, resilience, and low carbon construction. I'm also founder of a consulting firm, Concrete Nexus, and as part of that, I'm chair of the Building Resilience Coalition in the Pacific Northwest. You can visit our booth if you want to get more information. Also, there's some information about if you haven't joined the working group and after this session, you want to be involved, please use that flyer on your table. and there's a way to get in touch with me to add yourself to the working group roster. And we'd be happy to have you participate in the working group. There's also a QR code there to look at the working group charter. It's a draft still, and as the working group, one of our first objectives will be to finalize that. It's been scrutinized quite a bit up until this date, so I don't think it'll take a long time to get to the final version of that. But, you know, obviously the working group wants to be involved in that. Part of it may be that we're just simply too ambitious. You know, when you look at the 5-year plan, it may be that we're not going to be able to get there. But the fact is we're going to have some stretch goals along with that. So the working group's mission, of course, you heard from Brandy what that is, but there's some organization to the working group. There are 3 what are called panels here at Penmar. One of them is the Planning and Prevention panel. That includes risk assessment and land use planning and mitigation, infrastructure, interdependence, and all those things that go into policy, basically, planning for a potential disaster, so that, in fact, trying to reduce those disasters. So identifying risk and mitigating those risks. Design and construction, that's kind of where I will sit probably. And most of the time is, you know, identifying resilient standards and what we need to do with building codes, identifying how to make building materials more durable, fire resistant, climate adaptive, because we're obviously going to have to take into account climate change as we move forward, likely. We're also going to talk about low carbon solutions, and one of our panelists today is an expert in that area. How can we reduce the risks moving forward? And then we're going to have to deal with workforce training as well. So, and then the risk management and finance working group will address things like insurance and financing for resilient construction. Resilience doesn't come for free. But with the proper research, and we'll learn about that, another panelist who does a lot of research in the area of resilience, we can right size, if you will, our projects, infrastructure, building, construction, and so forth. As a structural engineer, I will say that, you know, brute force is sort of the operating principle, right? Let's just design for a higher loading. That will make our buildings more resilient. But who's going to pay for that? So we just need to make sure that we right size to the hazards that are coming. We'll talk about things like private financing. You know, a homeowner wants to increase his or her ability to resist wildfires or flooding for an existing home. How do we do that? You know, it costs money to do that, and how are we going to finance that? We're going to talk about incentives and the cost benefit analysis of actually doing all of that. It's not only for new construction. Of course, we have this incredible inventory of existing infrastructure and, you know, our buildings that we live and play and work in need to be addressed. We have a few near-term and long-term goals that are outlined in the document that you can get to with this QR code. And the near term really is just simply identifying the baseline risks that we face in the Penmar region. Now, a lot of communities, of course, already do this. And, you know, maybe the best approach will be to simply make sure that the best ways are communicated around the region. Obviously, you can always improve even on the best ways of dealing with identifying risk, but we'll at least be able to communicate throughout the Penmar region of those best practices. Identify the gaps in the building codes and standards with regards to how we design. You know, traditionally building codes have been designed for backwards looking, you know, what's happened in the past. Now I think we're going to have to look at what's going to happen in the future and how do we address building codes for that condition. We're going to develop a regional policy framework, again, looking at all the policies around the region and for that matter, outside the region, right? Well, we're not unique. Every region in the country, our two countries dealing with resilience or, disasters. So there may be some other frameworks that are out there that are, we could learn from here in this region and look at funding strategies, not only funding for resilient construction, but for funding that, the working group may have to do some research, how are we going to pay for that? The long-term outlook, a model for the regional disaster resilience, how, we're probably going to write some sort of a document or, some memorialize this in some way. We'll have to do that. Ultimately, it's the matter of results, lower disaster losses. Improve insurability. I'm not that familiar with any insurance companies here pulling out of, certain states or provinces because they're just too risky to insure. Obviously, that's happened in many other parts of North America. But we'll have to address that. We'll address economic sustainability. That's a big topic of this whole conference. I've sat in some really good working group sessions. And that's probably, aside from loss of life from disasters, the next big thing really is economic recovery. And 1,400 hours. So, economic stability after a disaster is a key for many communities, right? It could be decades or never. A community coming back from disaster resilience. And then we just need to embed resilience in all planning, construction, finance, and policy. That's our mission there. So with that, we're going to go right into the panel discussion. Basically, the panelists, I'm going to moderate the panel. We have two panelists with us already. Brandy Donaghy is going to be one panelist, and the Honorable Paula Simons, the Senate with the Senate of Canada, is going to be a panelist. But we also have four panelists online: Karen Collins, Kenneth, Strzepek, and I'll introduce each one of these because what they'll do is they'll give a 3 to 5 minute introduction and what their area of expertise is, what they can bring to the working group. So Monet Kunz and then James McIntyre. So let's get right into it. I'd like to invite co-chair Brandy Donaghy to come up and maybe talk a little bit about what you've been doing in Washington State with regards to policy there on resilience. I mean, obviously your work isn't done yet, but you have done a little bit of work there in Washington State to address resilience.
I am happy to talk about that, but I'm going to stay here. Podiums kind of wig me out a little bit.
Okay.
It always feels like a press conference and they're never fun. So Washington's done a few things lately in regards to resilience and trying to build that. I think it's first really important to recognize, like, we are in the circle of fire. We have 5 active volcanoes in the state. I have one in my county, which is like, yay. Also, a lot of the building construction that's happened in Western Washington, a lot of that was before we knew about the Cascadia subduction zone, because that we understood that in 1982, and well, there's been a lot of building prior to that. So we see all sorts of issues from unreinforced masonry buildings that just will not withstand if they shake too hard, they just collapse. And so this year has managed to get some funding together to help complete a solid inventory of that through our emergency management division, as well as help to the city of Seattle trying to coordinate with other entities that may have an interest, insurance companies and such, in order to be able to identify ways to make it fiscally possible for private owners of buildings that are unreinforced masonry to be able to actually make their buildings sustainable, to be able to upgrade them so they will not fall down. We've also had policy that allows us to put a Office of Resiliency under the military department. That is where our emergency management division lives. And that allows us to actually be more prepared for, as a state, more prepared for disasters, because for a long time, the main response was the coordination between state and local areas. Now we're really working on being able to do work, not just be there to coordinate communication. So I think that's really important. We had some floods in December in my district, but we've had flooding in various areas of the state for a while, and we've been working on ways to identify spaces where we need levees and other things in order to prevent larger disasters. And actually, some of the work that was done fairly recently helped in my district ensure that those floods were not nearly as damaging as they could have been. So we are working on finding ways to be more resilient. It is a hard sell in a lot of cases because, like I said before, the world's kind of in crisis mode. And so we see all these crises in front of us, and we want to deal with that thing that's right in front of us right now. And so getting the funding and getting the focus on those things that we have to do to be able to ensure that we don't end up in another crisis in the future kind of ends up taking a backseat. So one of my functions is to be that pain in the butt, to make sure that consistently reminding people that just because we are not there now doesn't mean that we won't be. And that, you know, as our emergency management director says, every dollar that we put into resilience and prevention saves us anywhere from $6 to $8 in recovery. And that doesn't take into account the economic damage that's done when communities are destroyed. So.
Well, thank you very much, Brandy. I'd like to introduce next the Honorable Paula Simons, Senator from Alberta and proud Edmonton resident.
Thank you very much, Lionel and Brandy. And I am going to stand up here because it makes me feel tall. Very little makes me feel tall. So hello, bonjour, and tanse. I want to welcome you all to Amiskwache Waskahagan. That is the Cree name for Edmonton, where we are on Treaty 6 land, and we are all treaty people. I'm going to start. Oh, there we go. I have two pictures here. In November of 2021, an atmospheric river engulfed the lower mainland of British Columbia. Highways, bridges, and major rail lines were washed away or inundated with water and mud. The lower mainland was cut off from the rest of Canada. Alberta and Saskatchewan were cut off from the port of Vancouver, and the port itself had to close temporarily because it was flooded. And when a port is flooded, you know it's a flood. Supply chains, still in recovery from the COVID shock, snapped. In the Fraser Valley, 1,000 farms and 15,000 hectares of farmland flooded. Floods forced 15,000 people from their homes. 5 died, and it's a miracle that it wasn't far worse. It's important to understand that the floods followed a record-breaking heat dome, which had caused devastating wildfires and soil desiccation. So when the rain hit, the slopes, unable to absorb water and without trees to anchor the soil, were uniquely vulnerable to mudslides. It was one climate crisis piled on top of another. We chose that picture as the cover of our recent Senate report, Urgent, Building Climate Resilience Across Canada's Critical Transportation Infrastructure, and you'll find copies sprinkled on your tables. The report and the picture encapsulate the need for us to be planning and building for the new reality of extreme climate events. The second photo is a picture of Alberta's beloved mountain community of Jasper after the 2024 wildfire. Northern Alberta has certainly seen larger and more destructive wildfires that displaced far more people. But Jasper is our park, the place where so many of us have made our family memories. When it looked for a horrible moment as though the entire town might be lost, we wept, not just for the economic losses and the human suffering, but for the loss of innocence too. And I chose those two pictures because they really do represent epiphanies for me. But extreme weather events are now routine. We must engineer resilience in our infrastructure and our society. We must build bridges, roads, and ports to withstand shock. And we must build networks of connections with resilient fail-safes built in, whether we're talking about railways, electrical grids, or human communities. But as Brandy has just said, climate change isn't just about catastrophic one-time events. This is the new normal. In the north, permafrost is melting, buckling roads and runways. Communities that long depended on ice roads and ice bridges can rely on them no longer. In our cities, our schools, our hospitals don't have the HVAC systems they need to handle heat waves and wildfire smoke. You can even smell it in this brand new building. Our municipal storm sewers and underpasses aren't built for sudden torrential downpours. In Edmonton this summer alone, we've seen an estimated $230 million in insurance claims from sudden rainstorms. Not one big calamity, but a series of small ones. I have a second slide. Lionel, let me have a second slide. We download responsibility for the maintenance and replacement of essential critical infrastructure to municipalities or counties who have the fewest resources and the smallest tax bases. I was shocked to learn in the course of our Senate studies that responsibility to maintain the dike works that protect the Vancouver International Airport and the Sumas Prairie Farm region in British Columbia have been downloaded to small cities such as Richmond. And in Canada, federal and provincial governments can't sort out who pays for what. If you look at international examples, things get even more complicated. Take the example of the Nooksack River, where we've got governments of Canada, the United States, Washington State, and British Columbia trying to solve that problem. And that's before we add in all the municipalities of the Lower Mainland and the adjacent First Nations governments. My friends, we need to build better and plan better. We need visionary national and international leadership, and we need private sector partners at the table. We must be done with finger pointing. We must be up and doing. Merci, thank you, and hi hi.
Thank you very, very much, Senator Simons. Next up, we'll have Karen Collins, and we're going to test the technology now. Karen Collins from the American Property Casualty and Insurance Association. Paula, Karen, are you there?
I am here. Hopefully you can hear me okay.
Yes, we can. Fantastic.
Great. Yes, so I'm Karen Collins. I serve as Vice President Property Environmental for APCI, our kind of shorter version of that very long name. As an organization, we represent home, auto, and business insurers across the U.S., including a lot of companies that insure millions of households and businesses throughout the Pacific Northwest and abroad. I do want to start with just a really simple observation. Insurance is often where an increasing risk becomes visible first, but it's rarely where that impact ends. Over the last decade, we have seen insured catastrophe losses rise dramatically. On an annual basis, insured catastrophe losses now routinely exceed $100 billion, and in several recent years have approached or exceeded $150 billion. And a large majority of those are occurring in the United States, often over 70% or more. And we're increasingly seeing losses resulting from what we call secondary perils. And that's really those that occur with greater frequency, like severe storms or maybe wildfires and floods. And not necessarily those that are the highest severity, which tend to be those earthquakes and hurricanes. Now, at the same time, rebuilding costs have surged, with construction costs in many of our markets increasing well over 40% since the start of the pandemic. And that means for every disaster, it is more expensive to recover from it than it was just a few years ago. And we're also seeing more communities exposed to risk as development is continuing in our catastrophe-exposed areas, whether it's wildfire, flood-prone, and more. And as Honorable Simons had just described, we're seeing more weather whiplash, as we kind of call it, where we're seeing this oscillation between these extreme weather cycles. Now, the result is straightforward. We are seeing more risk, more losses, and higher costs. And many people view that as an insurance challenge, but really from our perspective, it's much broader than that. Insurers are often described as that canary in the coal mine. We are among the first to see changing risk conditions because our business depends on measuring, pricing, and managing that risk. But the same trends are affecting insurance markets, and now also impacting housing affordability, mortgage lending, infrastructure investment, economic development, public budgets, community recovery. It goes on and on with that list. But in other words, if a community is more difficult to insure, it's more difficult to finance, develop, and grow. And that's why resilience has become such a central focus for our industry as insurance. At its core, we do two things. We help people manage and understand risk, and we provide that financial protection when disasters occur. But increasingly, we are recognizing that recovery cannot be the only strategy. The most affordable claim is the one that never happens, and the most resilient community is the one that experiences less damage in the first place. Now, this is why our industry has invested significant time over the last several years helping to advance mitigation resilience efforts, whether it's stronger building codes, mitigation, flood preparedness, resilient infrastructure, better land use planning, which others have already even touched on. But a major part of our work today at APCI is education and collaboration. And over the past several years, we've really worked to convene and participate in dozens of roundtables, summits, and working groups that have brought together insurers, reinsurers, agents, as well as builders, lenders, realtors, those in the academic space, mitigation experts, regulators, legislators, emergency management. Again, a very lengthy list of growing number of stakeholders. But those discussions have really reinforced one important lesson. Not a single stakeholder can solve this problem alone. We as insurers can provide data, risk insights, incentives, and financial protection. We see governments supporting mitigation investments, also focusing on infrastructure improvements, land use planning, and those modern building codes. Builders, lenders, utilities, researchers, and property owners as well all play critical roles. The real opportunity in our view is that alignment around these efforts must be around a common objective, and that's reducing the risk before disasters occur. And that's why I'm really excited about this working group. As noted, the Pacific Northwest and Canada, you do face a combination of wildfire, flood, seismic, severe weather, and other types of natural hazard risks. But as a region, there is truly an opportunity to become a model for that resilience collaboration if we can identify those practical actions that reduce losses, strengthen communities, improve insurability, and create meaningful incentives for mitigation. This is where we can deliver these benefits far beyond just insurance markets. We can improve that affordability, strengthen economic stability, and we can help these communities remain viable and resilient for generations to come. So with that, I pause and defer to my other colleagues, but really do look forward to the discussion today and learning from my fellow panelists on how we can accelerate this work. Thank you.
Thank you, Karen. Next up, we'll have Dr. Kenneth Strzepek. He's the research scientist with the Massachusetts Institute of Technology. Please welcome Kenneth.
Thank you. My first slide, please. So today I'm going to talk about how over the last 10 years, MIT has taken on to try to make a climate resilient campus. And what we see in the upper left-hand corner was back in 2016, MIT realized that there was a potential flood risk to the campus, but and they started to do some activities with the insurance company, and there wasn't sufficient data nor models to be used. And so they used a simple model which showed that the campus was in the potential flooding of the ocean from the Boston Harbor. And so you see in the picture in the middle, that's one of the buildings that precipitated this work. And they wanted to make sure the new generating plant, the electrical equipment was above the level. So they used this very simple bathtub model to do that and drew this red line. Well, at about the same time, the city of Cambridge decided that they were going to look at climate change and flood risk for the community. So they took a forward-looking approach, as we've heard in some of our talks, and they changed the regulations of the city that you now have to be resilient to the flooding that we expect in 2070, not the current flooding. So in that process, Cambridge went out and produced a study, and we see that, which is CCVA on the right-hand side, And you'll notice there's a large, right in the middle, a large blank spot, a lot of blue. That's where the city came and said, here, using the most sophisticated detailed models, what is the flooding risk? But MIT showed no flooding risk. What it turned out to be is that MIT had a lot of private drains, and the city did not know about this with MIT's work. So the model that they made was actually wrong and got MIT for a year thinking that we're in good shape. But then over the next 8 years, we've been developing a flood model in conjunction with the city of Cambridge, to look at the risk at MIT. And you see in the bottom middle that we have a new flood risk map. And in the old one that you saw the blank spot, we now see a lot of area going on there. So right as this was going on, the Vassar Street dorm was under construction. So using the initial material from our new model, what we did is we went and built the design of the Vassar Street model was to take and have not a basement in this model and to move all the important MEP infrastructure to the roof. Next slide. So over the next 5 years, we started refining that model. And then the next building that came up on campus was the music building. And as we see here, the music building was not able to move their equipment around due to the music quality and the acoustics of the building structure. So what they did was to develop detailed flood storage areas around as the building was being built, which reduced the flood risk and put the building within the Cambridge limitations, and then also reduced flood risk to nearby buildings. Then finally, we had another building, which is the College of Computing building. This was there. They saw that if we just raised the building 3 feet, we'd be resilient to the 100-year flood expected in 27 under climate change. And at the same time, we moved all the major infrastructure to the roof as well. And then there was a new building, which again was mentioned, was a lot of our buildings are old. This is the Met Warehouse, over 100 years old. This building was to be renovated for the new College of Architecture. So what they did there was to not, we couldn't do much to the structure or the design, but to take in armor and move the critical systems to be flood resilient and spend money on that ahead of time, but then move current functionality away from the flood risks. So what it did show us was the lessons that we learned is we need good data now. We need accurate models, which taste and cost money, but we need to work with our local agencies to look at the new standards and to look ahead. And if we spend the money now in all these 3 buildings that were new, the project manager cannot identify the extra costs that making it resilient happens. So thank you very much, and we look forward to any further questions.
Thank you, Ken. Our next panelist is James McIntyre with the Resiliency Company. Please welcome James.
Great, thanks. Can you go to the next slide? Sorry. Great, thank you so much. It's great to be here, and I think what's been really exciting about the conversation before me, is that it's talking about much more sort of step back approaches, because realizing sort of the cross jurisdictional, the cross financial nature of risk. And I think that's an important step, because the whole point is that what we're seeing is a lot of symptoms in many cases, but we're not necessarily looking at that sort of disease. And I think that was really what's interesting about MIT is they're looking at their disease. And so, in this perspective, insurance pricing is the symptom. And as background, one of the things we like to say is that we love in America to privatize profit, but socialize risk. And many cases, because we aren't necessarily thinking through these strategic lenses of really not spending, but investing in how we do this. But mostly when it comes to sort of the built environment, it's because we've lived and I think what was really interesting about the earlier presentations was talking about the volatility in the market. It's that the extremes are getting higher, and as a result, markets are actually beginning to pay attention to this, and it's starting to creep into places which were like stable and flat in terms of perceived risk, right? And you think about it, and that home insurance premiums are spiking. More the percentage of insurance you're now seeing as a percentage of mortgage payments are up extraordinarily. The Dallas Fed is projecting, hundreds of thousands of mortgages in the United States will fall into delinquency through 2050, basically in continuity as a result of this. And really, from this perspective too, we do socialize risk across the mortgage markets and other things, but the value of their homes really, and sits on people's balance sheets and sits on lenders' balance sheets to the extent that they've borrowed. So as we're talking about risk and built environment, we at the Resiliency Company and the work that we're doing is really focused on micro mitigation. How can we work with the built environment to sort of inject value through the lending market to sort of like also look at other signals like insurance and reframe risk as opportunity, especially when you see like literally home prices decreasing in places where they have higher risk, but there are opportunities with like higher, better quality roof, fortified roof through the IBHS. But lending is risk management in many respects, but like traditional appraisals are not measuring, are measuring really market value, not physical risk. And it's not that lenders are refusing. I think most lenders and homeowners don't know that mitigation lending or that you can borrow or what are even the right measures, where to start. Like if I'm going to replace my roof, what should I do? If I'm going to replace my siding, what should I do? These are all things that you can think about upgrades to reduce risk, but also potentially improve value and integrate resiliency into day-to-day sort of borrowing that you do. Borrowing that you do or upgrades that you do. And the challenge here is consumer behavior and really awareness. But risk is a universal language. We think insurers, lenders, utilities, legislators, homeowners all speak this language of risk, but it's how do we actually string these things together? And we're seeing interesting places like North Carolina's insurer of last resort, their FAIR plan, are taking actually, what are profits from that, redistributing it as grants. Small grants, $5,000 for when people replace their roof if they replace it to higher standards. And so this idea of reinvesting and really thinking through this captive risk concept. If you go to the next slide. But it's really about, and this is what we're focused on, is like, how do you actually build a science-based market, a standards-based market? Like if we're going to if we're going to like finance resiliency, we have to think through this lens of like, in the United States, we're using the IBHS. It works anywhere, but it's standards around like, where and how you should upgrade your home, the type of dispensable space you should have. And it's been shown to reduce risk. But we also think verification is a really important as we're developing a market. Like we want to grow this market to capital markets, to be like from a single loan to like hundreds of millions of dollars financing. Because we have a trillions of dollar problem on our hand in terms of the risk that our built environment faces from climate risk. And so we need to mobilize large sources of capital. So we're thinking through the same lens of, as does the International Capital Markets Association, and requiring things like visibility and verification and how you do stuff. But we believe that communities, because that's what insurers also require. They want to see that you've done the things so it's aligning these things as well. So, we believe, and I think that's what's exciting about some of the projects and what MIT's demonstrating is that community scale, really multiplies impact. You can't just push water or, one hardened home doesn't stop a fire. But blended capital, how can we incentivize behavior? This is what we're doing at the Resiliency Company with the development of a Delta Fund. Sort of how can we look at like, stringing together these resources, and I'm working with them to sort of identify these buckets that you can put together and how we can work with local lenders. So it doesn't matter where in the country disaster strikes or where you want to prevent disaster. How do you actually develop markets of local lenders that say, hey, I have a home equity line of credit. Why don't you borrow from it and replace your roof with a stronger roof or replace it with a fire, proof siding or ember resistant gutters. So and data connects it because I think we need to understand risk. It's got to be science-based. So as I said, I'm working with the Resiliency Company on that. Away from the Resiliency Company separately, I'm working with a company a lender in New York called Spring Bank, and we're working with the state of New York, for example, on developing small dollar flood mitigation loans, where we're really then doing the same verification process, but how can you actually capture too the value of mitigation of a homeowner on like installing a tank, but how can you actually monetize that, or not monetize it, but calculate it for your government so they know how much are you potentially reducing from overflow into the sewer system, because they may be spending billions over here and maybe there's a way to actually subsidize what you're doing. So it's how do we also integrate the public and the private as a way to support resiliency finance, especially micro resiliency finance. So I will stop there.
Thank you very much, James. Next, and our final panelist is Monet Kunz. She's with the Rocky Mountain Institute. Please welcome Monet.
Thanks, Lionel. Good afternoon, everyone. Monet Kunz. I'm a senior associate on RMI's Climate Aligned Industries team, and I'm here to support and help transform the cement and concrete industry. So we can move to the next slide. But before joining RMI, I worked in construction as a general contractor, both in pre-construction and in project delivery, supported in embodied carbon analysis during design and managing on-site concrete operations in the field. So that experience really gives me the perspective to figure out how we can move new materials from just promising ideas into real projects. So at RMI, we're an independent, nonpartisan nonprofit that's been driving market-based solutions to the world's energy and industrial challenges for more than 40 years. We have over 700 staff working across 60 countries, partnering with industry, government, investors, and communities to accelerate the transition to a cleaner, more resilient future for all. Within cement and concrete, our work really spans across the entire value chain, from producers, innovators, to designers, owners, and policymakers. And our role is really to create the market conditions to allow better solutions to scale, one by convening industry stakeholders, aggregating demand, and enabling that adoption and deployment. So if we can move to the next slide, please. So my work really starts with decarbonization, but we've increasingly found that resilience and decarbonization are not competing objectives. They're also often achieved through the same decisions. And so that's why I think cement and concrete really belong in today's resilience discussion. So from a resilience perspective, as many other colleagues have mentioned, we want to build infrastructure that performs in a changing climate, that lasts longer, and we can recover more quickly after disasters, that also strengthens our supply chain resilience. And at the same time, we need to reduce our embodied carbon to one of the world's most widely used construction materials. And so the encouraging part here is that, a lot of these same strategies can advance both goals. One example being performance-based specifications, where we can reward the outcomes and performance rather than just prescribing specific materials. We're seeing opportunities to diversify our material pathways, strengthening supply chain resilience while creating room for lower carbon solutions to enter the market. And also, finally, looking at life cycle thinking. How can we move beyond that first cost and consider durability, long-term performance, and just that whole project carbon? So rather than choosing between resilience and decarbonization, I think we have a real opportunity here to design projects, procurement, and markets that can deliver both. And so that's the perspective I will bring to today's discussion. I'll pass it back over to Lionel.
So thank you very much, Monet. We have a diverse expertise, obviously, on the panel, and it's honestly a little bit intimidating because some of these are, experts in a specific field, which I think maybe emphasizes that, nobody knows everything about resilience, every aspect of it. And, but you bring probably the audience, that is, and those on the working group bring some sort of expertise to the table that can affect the overall outcome of our work. Even though some of this may seem a little intimidating, you maybe not understand finance, that's okay, or insurance. I don't really understand insurance. It seems simple. It's a product that I buy and never want to use. And so, which is weird, right? I mean, everything else I buy, I want to use a lot. And so please, if you're not on the working group, I would encourage you to participate if you can bring just some area of expertise or knowledge to the working group to be successful in outcomes. So let's get into the questions. So Brandy, I'm going to go to you first. I know you've done some work in Washington State with regards to legislation. But what makes resilience policy achievable besides being a pain in the neck, apparently?
You're kind of assuming that it is. It's not always, because it is not usually the priority, that thing that's right in front of us. So being a pain in the neck can help. Being sneaky can help. Not that I'm a sneaky legislator, I'm not, but like there are some things that everybody is shouting from the rooftops, and I'm like, I just want to get this passed so that we can be safer. Can we just do that? Just kind of being low key. Another thing is to be able to tie it to something else that people care about. So when I'm dealing with maybe people who are focused on the environment, the benefit of building a community that is wildfire resilient is that we don't have to build it again, which means we don't have to transfer more supplies. We don't have to deal with all of those extra steps that create some of the things that they don't like, right? So it's figuring out how to tie it to something else that matters to people. And you can tie pretty much anything together if you try hard enough, because the reality is that everything is connected. So that's one of the key pieces that I use, is I figure out what matters to people, and then I tie what I'm trying to do to what matters to them. And that is probably one of the most successful ways to manage it, because again, if it's not right in front of us, very often it feels like we don't have the bandwidth, but we have to, because these things aren't going to go away.
Yeah, so others on the panel might also respond, even though you're not maybe in government. You're probably involved in policy, whether it's Paula, you might want to add to this, but others obviously are involved in policy. You might want to add to what we think how can we make policy achievable? So it looks like Paula has her hand raised. Or excuse me, Karen.
Yes, no, I'll give you a simple visual. If you think of the visual of herding cats, too often we see different stakeholders are all focusing on different pieces, different objectives, and that is really challenging when it creates conflicting signals for consumers. It makes it difficult for them to know what action should they take, and if incentives and financing and codes are not all aligned, this is where it can start to make people want to give up. So from an insurance standpoint, I think our first priority is making sure people know what should they do, what is an evidence-based solution. So what James alluded to earlier is the IBHS, the Insurance Institute for Business and Home Safety. They have essentially become the gold standard in the US as it relates to evidence-based standards for both wind resilience with Fortified, and increasingly now in the wildfire space with a new program called Wildfire Prepared. And we are now seeing great success because we have a standard, there is alignment, and now we're able to layer all of this public policy onto that same, so we're all rowing in the same direction.
Yeah, I agree that the IBHS is a great resource, and I did invite them to participate today. They just weren't available, sadly, but obviously they're going to be participating, and we're going to rely on them for a lot of the background that we need to move the mission forward. Looks like James, you have your hand raised.
Yeah, I think there's also something picking up too. I think it's answering that, but also responding to, something that Representative Donaghy actually said during her initial remarks, which is on sort of also, it's not just about the language, but it's also the trust with the people. They like doing, and I like, listen, I think there is an absolute, like when I said on the intersection of climate and buildings and how we do this together, but like from the sake of the human beings that are sort of, you have to do the work on it. The people who can't afford the fortified roof, we have to think through this lens of like, frankly, like where historically how we have isolated poverty in places in the United States and many times in the most vulnerable areas, those that flood and, people went to high ground to evade sickness and they also went there to evade floods. And who was left behind? The people who didn't have the money to move up the hill. And so we need to also make sure we're thinking through that lens. But I also think there's this really amazing opportunity because, two things. One, also another thing that the representative alluded to is that government really has a time to step back and figure out how to bring people together, find the solutions, architect them, because they're always literally fighting fires in some cases. And it's so difficult to take this step back as government and architect a policy that is so like that isn't just like meant to like get it done during a legislative session. It's like, how do you actually think through something that cohesively works with the science? And that is a big policy ask, is to like step back and craft something that works. And frankly, like I think a lot of what's really interesting though is that, surprising to our friends north of the border, local governments in the United States are actually pretty well trusted still. And so there's also like a really amazing architecture to build on the trust in state and local governments in the United States to like help implement solutions, to support flowing dollars most efficiency, using the science to do it. But I think it's like, what are the right levers for government to be able to step back to craft these policies? Think through, frankly, my philosophy is loan first, grant second, because we don't have enough grant dollars to go far enough. But one of the things we're doing at the Resiliency Company, for example, and some of the leaning into the fire science, we work with a woman named Carolyn Kuski at Insurance for Good, who's like literally written the book on climate insurance and risk. Risk and insurance is, we developed a grants playbook around fire science because it allows for actually saying, like, actually, in some cases, you need to community harden. You need to make sure you need to move the consumer behavior. So how actually can you use small dollars perhaps to get people to move? So there's a lot of big thinking, but I think it's how do we actually support government and policymakers with the science, with the IBHSs, with the insurance industry data, so that they're not the canary in the coal mines. They're actually sort of support the thought leadership, because I think the whole point is, I mean, any type of insurance is a pain to claim on, and I'm sure insurance doesn't want to pay out either. So I think we can figure out a way to align interests.
Thank you, James. And anybody else want to add to this discussion? I kind of have a follow-up question for Paula on policy. Paula, how can governments better align resilience policy across agencies and borders, which is what the Penwar is all about?
Oh, I mean, this is the fundamental challenge because, I mean, I can't speak for the American experience and the Canadian experience. It is often the municipalities that have to have the first line response and that don't have the necessary resources to do that first line response. So then they call on the province, and sometimes then the province calls on the federal government. So in a crisis, it's hard enough to coordinate a crisis response. The bigger challenge, the deeper challenge, is to figure out how we coordinate a visionary response to deal with the infrastructure debt that we have and to deal with the fact that our infrastructure is no longer fit for purpose. One of the challenges is that nobody gets very excited about funding storm sewers. You can't cut a ribbon for that. And so there are fundamental under the ground infrastructures that need to get fixed that are not the least bit sexy. And unfortunately, I think governments at every level sometimes are distracted by the things that look the most urgent, which may not in fact be the most fundamental. So I was up until recently the deputy chair of the Senate Agriculture Committee, and we were embarked on a big study about wildfires. And the study witnesses told us two different things. They said, one, you need to do more to empower local communities to fight fires when they're happening, whether those communities are First Nations communities or small towns and counties. And then they said, two, we also need a national coordinating response. And so you need to have both those elements in place. You need to have the empowerment of the local communities that have the frontline responsibility, and you need some kind of coordinating vision that looks at the entire country, at the entire continent, and says, where are our biggest points of crisis? What are the 100 things we most need to fix? And where's the vision and the plan to get them fixed first?
100 things. Oh my gosh.
10,000 things.
Yes.
But we could start with the things that are the most urgent. I mean, the Vancouver airport is a pretty good example, and it's one of the ones that we detailed in our study. It's called Island, it's on something called airport, it's the Vancouver Island Airport. It is on an island. It is one of the most fabulous airports in the world. I love the Vancouver airport. And the combination of rising sea levels and storm surge mean that it is in legitimate peril of at one point sinking into the sea. It is one of the most fundamental pieces of transportation infrastructure on the continent, especially in the Penwar region. And we can't leave it to the small municipality of Richmond to defend the island against the waves. It's a little bit like a scene from The Lord of the Rings. You have to, the hobbits can't look after the entire kingdom.
Yeah, it's a great point, and
It didn't really mean that you were hobbits, but
and not only that, I mean, there are a lot of newer cities that have maybe fairly new infrastructure, water infrastructure, but also maybe it was designed to the older knowledge, right? And now we're confronted with having to design for what will be the future of the loads, whether it's water flooding loads or seismic or wind or wildfire and so forth. So, so Karen, I'm going to go to you here for a second. And what makes risk harder to insure, and what mitigation actions would help? You touched on it a little bit in your introduction, but maybe you can expand on that.
Absolutely. I think it's important to recognize that at its most fundamental core, insurance, we're a risk transfer mechanism. And as an industry, we've done a lot of advancement over the last few decades, a lot more sophistication in measuring, pricing, and managing risk, really across the spectrum, insurers, reinsurers, the large catastrophe modelers. But when you look at what makes it harder, we look to weather, more frequent, more severe. When you concentrate a large amount of exposed properties in a small area at high catastrophic, hazard risk, those are challenges. But I think it gets most difficult for the industry when it becomes unpredictable. When you see very, very sudden events that are shock events. We just came through a period of that, really, with the COVID pandemic and supply chain inflation. Very high impacts in a very small amount of time to adjust to, which created a lot of market ripples. But when you look more to like the mitigation space, I think it's also important to recognize that when signals around risk become distorted, that also makes it more difficult to insure. We see a lot of public policy conversation on, how do we make risk look more affordable rather than actually reducing that underlying risk? And that means, are we seeing suppression of risk signals, whether we are suppressing and shifting costs into, residual markets or state or government public programs? This can all create uncertainty around how losses are going to be paid, and it can weaken the incentives also for mitigation to make that long-term risk management more effective. And so there's a recognition in our industry that, the risk is the risk. Someone is ultimately going to bear that cost. And really the most sustainable path to not just affordability, but availability to insure these properties is that reduction of risk, which everybody's kind of highlighted, those building codes, the mitigation, the infrastructure, more informed land use decisions. We can't just stop development. The West is doing some of the most expansive development in recent years. We're not saying to not do that, but how do we do that where we are also mindful of what the hazard is and that we're building it to be able to be resilient and withstand those impacts so that we can continue to be more sustainable?
Excellent. Others may want to comment on sort of the codes, incentives, and policy tools that could be used to identify risk and make it more attractive for insurers and insured, for that matter.
Well, in fact, I would flip it the other way around. I think it's the insurance industry that might save us by saying to people, stop allowing people to build on flood zones. Stop allowing people to build in areas that there is known risk. I mean, I think that is exactly the point. If the insurance industry is telling us, it's okay, it's fine, we'll be there for you, that's not good for them or for communities. I think we actually are going to rely on the market signal of insurers to say, this is no longer a viable place to build. This is no longer a viable project. And we actually need that market signal because sometimes people don't like it when governments tell them that they can't do such a thing. And sometimes if the province or the municipality says you can't do that, people get very uppity. But if they can't get insurance, it sure sends them a very clear economic message that what they are planning is not a good idea.
Yeah, good point. Kenneth, it looks like you're back, which is great. And looks like you have your hand raised. Would you like to respond?
Sure. One of the things that we've learned as part of the MIT campus work, it is the working together with the insurance and the local municipality at the same time. The insurance company saying that we need to take actions to reduce the risks, and there are simple actions, and then rewarding those actions with reduced premiums. And so, and also, was mentioned before, the uncertainties that are there, and as you do a better job of gathering data or doing models, that reduces the uncertainty, which reduces the exposure to the firms. There was a win-win from both sides on working on that. The other side that's, I think, really important on insurance, which we're seeing here in Northeast Colorado, is municipalities and counties who are denying the nature of climatic change and what's happening. In those same towns, the insurance industry has come in and said, we're having more wildfires and we're having more hail. We are changing our insurance policies, and if you don't upgrade your roofs to hail resistant, you're not going to be insured. And then they're also making the deductibles much higher. So the insurance companies, which is looking at data scientifically and objectively, are seeing the risk increasing, and they are transferring the risk to the local area. But again, then there are many that can't afford it. So the issues that James has talked about and others is how do we share that risk when it starts becoming financial amongst the community, insure it socially. So those issues of how do we mitigate those risks across area with investments in capital up front, we're going to have to work on that to the equitability of that. But the other thing is looking forward. The city of Cambridge looked forward. The city of Lexington, Massachusetts, rather than looking backwards 100 years, they changed by looking back 20. They didn't have quite the gumption to go looking ahead, but we need to be changing those risks because they're not the same anymore.
Yeah, so James, I'm going to get you in a second. I realize your hand's up, but I just want to go down the path that you just brought up, Ken and Karen. Really is, my short interactions with insurance industry and companies is that they're all about data, right? And usually it's actually physical, data from past experiences. But in the sort of the new world is modeling, like Ken is doing and other researchers, obviously. Do you see that will become, I guess, standard in the industry, or is the industry resistant to using modeling as opposed to empirical data from the field?
I'll jump in. I would say that the industry is absolutely embracing modeling, and not just our industry. We're seeing it with a number of other stakeholders. The utility industry is increasingly using modeling. We're seeing governments trying to help do a more data-driven, approach to how they invest some of the resources with addressing, grant funding or where to do land use, mitigation with wildfire risk, et cetera. I think that when you look at modeling, we can look all the way back to Hurricane Andrew that devastated Florida in the early 90s. And it's about how do you identify the potential magnitude of these events, but also ensuring you have the capital for all the smaller aggregate level losses that are happening with some of these frequency driven perils. Modeling is so important really in this era of increasing climate impacts because yes, prior to, we've looked at historical, and in the property insurance space, it'd be, 10 years, 20 years, but everything has evolved and changed so much that what is historical is not really indicative of what this future exposure is, with both new community growth and with the climate impacts amongst a lot of other factors. And so modeling creates a more stable forward-looking view that gives better confidence for insurers to then price risk, and ensure that ultimately they have the capital to be able to then invest and provide coverage in these higher risk areas. So it is an increasingly critical tool for a number of different reasons. And again, the risk signals, all of it is about how do we manage and how do we price. Insurance is fundamentally risk-based pricing. If risk is increasing, prices are increasing. If you are taking steps to meaningfully reduce risk, you'll generally see your prices come down. And so we are trying to not be the mean parent in the room of like, don't do this, but you do need to provide those signals. And that is an important part of that risk signaling, particularly in these higher risk areas.
All right, James, you had your hand up, and if you put it down because you didn't want to respond to this, that's fine, but I have a follow-up question. So maybe you add your comment and respond to this. You mentioned, vulnerable communities. So how do we avoid shifting the cost or the risk to those vulnerable communities?
Yeah, I think the first, I think it is really difficult because I think this is not historically how we have operated, right? The people, like I live in New York City, and these, public housing is the first housing to lose power during a storm. It's the last to get it back in many cases. And I think that to the point of how we think about our infrastructure investments, um, we we have to look at, I think the whole point is how do communities look at economic bases? Like we established during the pandemic that, oh, it's great to have essential workers, but like, do we value whether their homes get wiped out? Maybe we should value that too. Like we can't just look at, like, I think, it was interesting. The Resiliency Company was born with this sort of thesis that immediately after a disaster, there's this whole interest in money pouring in and excited about what happens like a month or 2 months after a storm, like you retreat. And I think this whole idea, if we want to solve for vulnerable communities, we got to solve during the off season because we cannot wait till a storm hits, and we have to do preventative medicine. It is so much cheaper. Avoided loss is a huge thing, and we need to think through it as a community to say, like, how much does it cost if my workforce doesn't show up? How much does it cost if my businesses can't open? How much does it cost? Lahaina lost its 25% of its tax base in like a day. Like thinking about this, and I think this is the really interesting thing coming back to that whole data-driven approach is like, we also need to understand, like, we need to be using data to figure out where and how we should invest in our communities. Again, let's not spend. Like when we build a new school, let's think about how it can play a role in resiliency. Like let's think about our marrying in like resiliency into across all areas of government. But I think that's the whole point of coming up with standardized models, because that's what's going to drive that. Because local governments, like people and buildings, have inherent place-based risk. And I think what's really interesting about what Senator Simon was talking about is like governments looking for market signals. And I think this is a really important thing because we mask, the market masks risk until it's almost too late. Like, look at the way that we had the subprime crisis. It's like, oh, it's a great security until it's literally a failure, right? And so the same thing here, if we think about like one of the biggest things that's happening in the United States mortgage market is Fannie and Freddie going public. But if we have inherent place-based risk, like there should be a disclosure issue in the U.S. mortgage market around place-based risk and what it means is home values. Like we should figure out how this becomes a material disclosure issue around climate, or inability to get insurance becomes a material risk in disclosure in the housing market. And it's the same thing. I think one of the things that I think has been, and I'll stop real quick, is just the Vancouver airport example is really, really important because I think, I'm a Michigander, and I understand the importance of US Canada cooperation, and a lot of these solutions, like, it's not just Canadians that depend on the Vancouver airport. This is a global we all have a vested interest. And so we also need to think through that financing lens of like what it's going to take. How do we build it into a ticket charge? But we cannot do deals like build the Gordie Howe Bridge and then go back on deals if we want to develop partnerships on revenue side, because this is what finance is about, contracts. And you cannot finance this stuff at scale, doing project finance and then blowing up revenue streams and changing this. And I speak as an American, but like I just also speak as someone who comes from the bond market, and that's the type of thing that like will kill structures over time where we need to develop intergovernmental cooperation.
Yeah. So does anybody else want to add to that thought?
So I have something that's not that thought. It was one of the earlier thoughts from a conversation about when we're doing new things and new development and incentives and things that we can do in order to ensure that they are, better than what we have now. But also we have to consider the impact of new development on what is already existing. And so like a perfect example is near, and it's a very small example, but near where I live, they put in a new neighborhood. And after they put into the new neighborhood, the road next to it flooded all the time. Never flooded before, but it flooded after we put in the new neighborhood. So when we're looking at risk, we also have to be looking at the risk that the changes that we are trying to put in place or the development that we are trying to make is going to be making on the areas around it. Because those people, they don't have any choice when somebody, decides they're going to build at the top of the hill and they clear cut in order to be able to do it. And then there's a landslide that they were already there, right? So we have those, it's that secondary impact as well, I think, that we really need to focus on.
Well, Paula, it looked like you were ready to also add.
Just wanted to say, I mean, thank you very much for those words about the Gordie Howe Bridge. But it doesn't matter whether we're talking about a huge international project that's being caught up in politics or a local town council that can't decide from meeting to meeting what it wants to do.
1,500 hours.
People who are going to invest in infrastructure, large or small, want certainty. They want to know that that project is, that the funding is there, that it's going to go ahead. If there's private sector investment, the private sector obviously wants to know that the jurisdiction isn't going to change the rules halfway through. But, years ago when I was a kid in Edmonton, we had a fight in this city about a piece of property called Keeler Road, which was this like little road that went through a very pretty part of the river valley. And it was a shortcut for people trying to get from the west end to the south side. And I don't know how many city councils, it took decades before the city council finally said, no, this is stupid. The road is not safe. We're shutting it down. So it doesn't matter whether you're talking about something as large as the Gordie Howe Bridge or as large as a major new airport or something as small as fixing a storm culvert. You have to make up your mind and then give people the assurance that you're actually going to do the thing and you have to stick the landing.
Yeah, definitely uncertainty is an issue, regardless of the politics. There's uncertainty in everything that we do, honestly. And, sometimes I think we can take advantage of that, like scientists like Kenneth and others at every other university use uncertainty, the science of uncertainty to benefit them. And I'm going to come back to you, Ken. Because what I want to do is I want to, Monet, in her expertise, hasn't had a chance to weigh in yet. So I'm going to switch a little bit topics to include sort of this idea of low carbon future construction and how it can reinforce or mitigate future construction and reduce risk. So, how can low carbon construction and resilience reinforce each other, Monet?
Yeah, that's a really great question. I think it really starts with understanding the scale and looking at, concrete, the most widely used human-made material, and cement, the key ingredient in concrete, is 8% of global CO2 emissions. And so you pair that huge scale with the, aging infrastructure that we've talked about across jurisdictions and the massive future demand across the globe for new housing, energy, transportation, data centers. And so I think the challenge is we're having to adopt to the changing climate while using that super key material and also mitigating emissions from building that infrastructure. So I think where they reinforce each other is if we don't make that connection, then we risk this cycle where we're rebuilding for climate impacts in ways that also contribute to future climate impacts. And so I think there's a real opportunity across, each of our sectors, but even within building sectors, that there's no real silver bullet in cement and concrete decarbonization, and it's going to take a portfolio of solutions working together. And so I think sort of the goal here isn't just lower carbon infrastructure, but it's that lower carbon infrastructure that is lower carbon, that is resilient, that is durable and affordable, reducing that rebuilding cost. So I think that's sort of the key connection there.
Yeah, and I would say, obviously my career has been spent in the cement and concrete industry, and I agree that, we have a challenge to reduce carbon footprint, but other building materials do too. And, concrete is not always the solution. We think concrete has been used for resilient construction and durability for infrastructure and building structures for so long. So I do think that there is an opportunity for all building materials to address this idea of decarbonize, build to a resilient standard, which I don't think are mutually exclusive, right? I mean, we can do both. I hope we didn't lose our panelists. They're still there? Okay, excellent. I'm going to go back to you, Kenneth, because, I mentioned this idea of using the concept of uncertainty in research, right? Can you address that a little bit and how that's used to turn it into a positive thing rather than a negative?
Well, all uncertainty generally leads to more costs as we want to hedge against that. And what's important in risk is individuals and institutions' risk aversion. And so our ability to absorb a negative outcome as opposed to gain from a positive output. And so we have been using these terms like people have heard about the 100-year flood. That's the magnitude of a flood that in the United States, FEMA, we have to protect against. And if your home is within that 100-year floodplain, which means there's a chance of 1% every year of a flood occurring, then you have to get flood insurance. So that's mandated by your mortgages. So we want to look at that from different ways. And many organizations self-insure, so they're willing to take it. And sometimes they self-insure out of ignorance. But there are a number of ways that we look at risk. And the biggest one that one looks at is what is the maximum damage that I can absorb, and then how much does it cost for me to reduce that risk? And the problem is an individual sees that event individually one time. What is the chance of in the insurance world, what is the chance I'll have an accident this year? But then, so you're trying against if you have a total of your car, it's a total loss. Even if the percentage chance of that is low, insurance industry, they look across all events. So they're able to use the concept of the average or expected value. So they come up with setting their rates and other things based on what is the expected payout in a year. And hopefully, because with reinsurance and other things, we can mitigate that risk to the statistical level. But you could have a couple bad years in a row, and then that goes on. So generally, what we see is what is your institution concerned about? And we, in talking with the infrastructure world, particularly stormwater, what many other municipalities are more concerned about than that catastrophic 1 in 100 or 1 in 50-year storm. They're worried about the lower impact but more frequent storms, the 5 and 10 and 20-year storms. And what we're doing some research on that with different countries around the globe, and particularly in North America, where people are paying for their stormwater, they're expecting a service that they don't want their basements flooded once in every 10 years. They want it once in every 20. But if the 100 years comes, that's an act of God. That's something that we know it will cost more money than to build the protection than what we can afford. So we have to live with that risk. So it's very much related to the institution, to the community, to the culture on how you deal with risk. Some cultures are much more risk averse than others. And generally, what happens is the poorer you are, the less you can absorb a risk, but many times you don't have the wherewithal to reduce that risk through capital. So all the things that we've been hearing, that we really need to take a integrated approach with both individuals, with insurance company, corporate, and government to address this issue of what is the acceptable risk that we can take as a society, and then how do we share that risk across different groups in different locations. But there's lots of, and what I've found is it's in the last 10 or 15 years of my career, is the mathematics of our theory and our economics and our Bayesian decision theory. That's a nice way to start, but it's not reality. And we have to work on what is it that local organizations, people are willing to deal with in risk, and we have to work around that. And then the other thing I'd add, which is a little tangential, but I'm very disappointed to hear from the representative from Washington that we train all of our students when we do flood management that you cannot harm someone downstream. And that's the whole purpose of all the models we've built. And that shouldn't have happened. If a good design was done with proper parameters, you're supposed to design into your system the protection of increasing flood downstream. And in the state of Colorado, that is law. You cannot harm someone downstream with what you do upstream. So this might have just been a one chance, but we need to be spending the money to model properly, enforce that upon that, and then also to be looking, because things are changing. We are not in the same as the last 20 years. The next 20 years is quite different in flooding, and we have to be taking that into account in our regulations.
Yeah, so I don't know if you want to respond to that, Brandy, or should I go on, because I know Paula wants to make a point as well.
Yeah, no, I have no idea if it was inadvertent or just not planned for, but those things do happen, so we need to keep them in mind.
Yeah, and I think it's probably a policy that we'll probably look at as part of this working group, is to say, hey, even if you design a community or a structure for its own resilience, you can't affect the resilience of everything else around you, right? It can't cause harm to anybody. So Paula, you had a point.
We've spent a lot of time focusing about the risks of catastrophic events. And I want to come back to a point I made in my opening statement, which is that we also have a new baseline normal for which we are not prepared. Those of us who live in the Pacific Northwest have probably spent most of our lives without air conditioning, without a need for air conditioning. That normal has changed. We have all kinds of infrastructure in the Northwest, hospitals, schools, prisons, all kinds of places where people are vulnerable, where we have no proper HVAC, no proper air conditioning, and no proper air filtration to deal with smoke. We have all kinds of, I don't know if there's anybody here from Alaska or Yukon or Northern Alberta, Northern British Columbia, where there's permafrost. The permafrost has melted. You can't fix that. So you need to have a new kind of infrastructure so that planes can land and roads can be built. For northern communities that rely on ice roads, if you can't reliably have an ice road for more than 6 or 8 weeks, you're going to have to think of an entire new way to provision those communities. And so some of this stuff is not sexy. It doesn't involve tens of thousands of people being displaced or giant flames or roads falling apart. It's just the new normal in which we live. And I think one of the things that's really important about this is that we have to build resiliency within human communities. We have to rely on one another. Individual isolated communities cannot survive in this new world. We have to be able to open our doors to climate refugees at a snap of a finger. But we also have to be able to backstop each other, because that's how you have fail-safes in a system. And our electrical grid is a huge part of that. We are going to need more electricity, and this is even before we start adding on AI data centers. And we're only going to be able to sustain that kind of upgrading of our electrical system if we have proper integrated electricity systems across the Pacific Northwest. That means proper tie lines and proper systems, so that if you could shed load here when you need it there, that hydro can be here and solar can be there. The only way we get more solar and wind online is if we have base load that we share. So we use that as a metaphor for the sharing of responsibility that we're all going to need to have to build a resilient our quadrant of the continent, only if we work together.
Yeah, thank you, Paula. I do want to get to a few more of the audience questions, and a lot of them have to do with cost, as you can imagine, right? Because again, resilience doesn't come free, and we just have to right size it, I guess, is the point, right? Don't pay more than you need to address the hazard. So let's go with this. The question here is, we all support building more resilient communities and reducing disaster risk, I think. Well, maybe that's an assumption. But every new building code comes with a cost. How do we strike the right balance between increasing resilience and keeping homeownership affordable? At what point do additional code requirements begin pricing people out of the market, and how do we prevent that? And let's start with James.
Yeah, first of all, I think there's a couple things. One, we need to revisit how we build altogether. In many respects, I think, and looking really again at the science of materials, I think that's why the point earlier on concrete was really interesting, because at the same time, some of the best built structures from a resiliency perspective are also some of the best from the energy perspective. And so when we look and think about this idea too of, we need to be valuing and identifying the value streams and looking, one of the things that's really interesting, as I said, I live in New York City. The High Line, if any of you have visited, is an old rail yard in Manhattan. And that was just it. It was an abandoned rail yard. And from it rose a neighborhood. You built a park in an abandoned rail, and from it, you built a neighborhood in one of the highest destinations. It wasn't something was there. With the case of resiliency, it's about how can we actually look and find value that we may not see. Or it may be, hey, and I think this is from a policy perspective, that value may not be materialized in this election cycle or within this politician time. There are decisions that we have to make on budgeting, which are really, really hard to align resources. And I think this is where, but I think from that, we can begin to properly value avoided cost. Because the question is when a city builds a seawall, are they negotiating for reductions in insurance premiums for the tenants that live on the other, or the owners of real estate on the other side of it? We are not all together fighting the same battle, but we really are, because it's one storm coming at all of us. And the storm does not choose the jurisdiction where it hits. It chooses exactly where it decides to go. And I think that whole point is that then we have to decide what resources we can put together, because in order to for it to pay for itself, we need to say that hey, maybe the city is spent, it costs, and this is especially around cloudburst issues with heavy rainstorms, is the Department of Environmental Protection in New York City, for example, I read a report that like if the private sector were to implement the same solutions, it would be 40 or some percent less, right? Well, I'm like, great, then let's incentivize the private sectors to do this. Like if we can figure out ways to allocate resources into the private sector, or government can use the data that they have to inform decisions and really support folks. And really like leverage outreach and building trust of saying, hey, I know this is crazy. You love your front yard, but we're your whole community is going to have to give up a little bit of space to make it defensible against wildfires. We're all going to have to get in to do this together. And I think these are really tough choices because we love like in America, as you know, like we love our freedom to do whatever we want, but we don't have the same, like the storm gives me no freedom. And so I think that we have to think through this lens of actually like where do we actually not have a choice and I think the existing infrastructure is a really important point because through all these flood maps and all these models which are changing it through the time, 80 or plus percent of buildings that are going to be around in 2050 are already built. So we have a big issue with our existing infrastructure as well that we need to be thinking through as well.
Yeah, I see, Karen, you have your hand up, and you're probably going to address this issue, but I want to also ask another question that you think about while you're answering this question is that, how close are we to insurance companies using dynamic pricing, which you kind of do already, but, for premiums and take into account lower versus higher risk. And maybe you can explain a little bit about how insurance risks or how insurance gets priced because it's about sharing risk, right? I mean, even the worst risk can potentially get insured, maybe at a higher rate. But the idea of spreading the cost around everybody, including the low risk. But anyway, respond to the first question, which I kind of forgotten already. And then response to the second one.
So the first question was about the cost of codes and implementing that
Yes.
and what is kind of the benefit. And that, as I kind of mentioned in my opening remarks, we have been doing a tremendous amount of discussions, roundtables with a lot of different stakeholders, both mortgage bankers, realtors, those in the construction industry. We've actually done some recent research with those in the construction industry on what have those costs been in some of our, southern hurricane-prone states as an example. And where those most significant costs have actually really been from their input more on like solar, green energy. But when you talk about physical disaster resilience, those costs are actually not as substantial, particularly in the wildfire space more than anything. And those are most reduced at new construction versus the cost to retrofit. So there's a tremendous benefit just there. But when you look at it from a mortgage banking, real estate insurance standpoint, you're looking at the cost to buy and kind of year zero versus the cost of home ownership, the rest of that 1 to 30 years that you're in that mortgage, and those fixed versus those variable costs. And what we're seeing, because we haven't leaned into resilience, is that variable cost of insurance with more losses, more costs being embedded, that's what's pressuring more so the home ownership and being able to stay in home ownership once you've gotten, that first mortgage purchase. And so there's tremendous, as was mentioned earlier, for every dollar spent on mitigation has a return. And we've seen that upwards of like $10 to $13 with more resilient construction. There's a tremendous loss avoidance. If you look at it even just from roofs, if you have to fix a roof, you have to fix the roof. But if you don't put that new roof on or address it, it's all the loss that comes into the home and all the personal property and all the displacement of time while you're out of that property. All of that adds up. It's very, very significant. And as was also mentioned, kind of that sustainability conversation, that cost and the cycle of destruction and reconstruction, it really is not sustainable economically, but more so from an environmental standpoint. So as an industry, we are trying to move away from the reconstruction cycle and move into more of a predict and prevent. And that's where the modeling and the pricing that you just kind of talked about, how are companies approaching this? And where there is risk reduction, insurers will incentivize that through risk-based pricing. We're seeing a lot of that through discounts both in recognizing IBH as fortified for those that have wind resilience. It's very widespread in our southeastern states, but we're starting to see more of that coming further west. Also in protecting against hail, which I don't know we see as much of hail in Canada, but we do quite a bit in the western US and central US. But the new standards for IBH as wildfire prepared, we've kind of seen a tipping point as an industry since 2017, 2018 in wildfire losses, and the standard for wildfire risk reduction, that mitigation, really only emerged a few years after that. And so there's a tremendous coalescing coming up right now in a number of states to embrace that standard, incentivize that standards. Insurers are reflecting that. They're aggressively requiring mitigation for properties to be more mitigated to those standards. And so you are seeing that being reflected in insurance decisions and pricing. And again, we want it to be based on what is truly evidence-based, what is going to meaningfully bend that risk down versus just miscellaneous actions that feel like activity, but are truly going to be those outcomes that you want to truly bend down the risk itself.
Thank you. Brandy, you have a comment?
I think like when you look at the balance of the costs, there's something to consider. It's kind of like fast fashion, right? You buy an outfit and it's pretty cheap and it is not made to last. And so you wash it once and the strings start coming out. You wash it a few more times, there are holes in it. You can't use it anymore. But if you buy a decent suit, then it lasts you for 20 years. And so that's got to be part of the calculation as well, because every time we have to redo something, every time we have to rebuild, that's another cost on top of it. So if we can get to the point where we recognize that those differences, which really aren't as much as expected, I think I want to say Oregon was finding that it was much, much lower than expected to build more resiliency, while it was like in the single digits of an increase. But overall, again, if you put a little bit more into it now, it's cheaper later on. And we have to keep that in mind.
Well, that's, Monet, you had your hand raised, and then I have a follow-up question after you respond to this one.
Yeah, I just wanted to add that, I think another analogy, I think this is the adult version of the marshmallow test, right? Like, what delayed gratification can we convince ourselves is important enough? And I think, to summarize, we've sort of rewarded what's easiest to measure cost-wise today, the upfront cost and the immediate embodied carbon reductions, or sort of the immediate, but looking more at the sort of long-term life cycle thinking, how long are these buildings going to last? And to Karen's point around retrofit is so much more expensive than new construction, and dealing with the infrastructure that we have today, how can we sort of embrace and enable the existing infrastructure in a stronger, more resilient future? So just wanted to add those 2 cents.
Yeah, so on a follow-up, I've worked with RMI. I can't remember if you were involved or not. I'm sure you were, but on this book and claim concept for carbon reduction. And you'll probably have to explain book and claim. It's a little bit like carbon trading, but is there a place in resilience for a system like that to incentivize companies to innovate? I don't even know. I'm just throwing that out there.
Yeah. So book and claim is essentially a model that allows certain buyers to book a credit and claim the environmental reductions from that. And so I guess the most clear connection I can see here is when products, cement and concrete products, for example, are produced in one region, but where the buyer wants them is not in the same region. So cement and concrete, very localized products. So book and claim enables buyers to purchase EACs, environmental attribute credits, to claim those reductions under their Scope 3 emissions accounting, as long as those products are sold and produced and put into the industry elsewhere. So I think there is an opportunity to have that geographical mismatch solved, and also enable the financing into in investments where it's needed, not always where the product ends up. So.
Yeah, definitely the whole concept of book and claim is a little esoteric, although, once you get into it, it makes some sense. And and maybe that my idea of somehow incorporating resilience into that equation isn't going to make sense, but it's something to think about. Kenneth, you had a thought.
Well, two things I just wanted to add. One of the things that I think as we're talking, which is really, really important, and I like the great mix that we have on the panel, is that what we're seeing more and more is the need for cooperation. And for example, in Boston, we have the Massachusetts Water Resources Association, which is dealing with flooding over 30 communities because of this upstream, downstream effect, or even downstream backing up upstream. How can we work together? We have to cooperate. Same thing in Northeast Ohio Regional Sewer District, which is Greater Cleveland. It's an organization that ties together all the municipalities to see how they can work, because sometimes you can save money by doing a regional work, or we all work together on improving things somewhere else in the catchment, which is cheaper than doing it locally and sharing. And then we have Mile High Flood District here in Denver. So, and Santa Ana Watershed Authority in California are a few of the ones that I've worked with. And so I think what we're trying to do here on resilience is taking it from a number of different perspectives, but in the management of it, that's why I'm so excited. We have government, we have private sector, we have industry, we have others working together. And that's going to be the way we're going to do this, because this is costly. As we showed at MIT, some things, if you're starting it brand new, that's going to be easy to bring resilience. But mitigating old buildings and doing that, we heard, 80% of the buildings are already existing. So bringing that cooperation together is going to be really, really important, and one of the keys for what we're doing for the future here. And I think for your committee, this is something that we want to work well. And we're seeing this not only in North America, but it's happening in the developing countries through a lot of the development agencies are forcing the public-private partnerships to do that together. And then lastly, one of the things we want to forget when we do benefit cost analysis, because we don't want to spend 16 million to protect 200 million, 16 billion to protect 200 million a year potential damages, is the cost of disruption, which isn't measured many times. We did work for the US EPA on the impacts of increased flooding on bridge damages, and the cost of the delays and extra carbon, but particularly just the cost of human time and gasoline and fuel to go around for detours while bridges were being restored, is almost 5 times more than the cost of the repairs. So the question is, who bears the cost is really important in some of these things. We have to look at it systemically and look at it from that. And just like our neighbors in the north learned from acid rain, we were pouring out the acid and the emissions in the Midwest, and it was causing dead ecosystems in Canada. So we have to look at what we call these externalities. Who's absorbing those risks, and take a systemic view to that.
Thank you, Ken. Karen, it looks like you have a thought on this. Oh, it looks like you're muted still, Karen.
Sorry. Yeah, just building on what was both said, but maybe emphasizing some of the points raised by Monet. I'm not specifically as familiar with book and claim, but really from an insurance standpoint, our industry is so focused both on the built environment from a risk reduction, but really there's a tremendous amount of conversation on the natural environment as well. And really the conversation of resilience and carbon reduction, when we look at it in the wildfire space specifically, there's a lot of growth and attention on what they refer to as ecoforestry. So many of our forests, especially throughout the West and North, have served as important carbon sinks. And as we have seen, unfortunately, these really catastrophic fires have devastated many of these plots that are holding these carbon sinks and releasing that back into the atmosphere. Even just right now, we're watching these devastating fires across Canada right now, and the smoke that's carrying through. There is, at the federal level in the U.S., a lot of focus on how can we be more good stewards of our natural resources, our forests. And so an important piece of legislation has been one that's called Fix Our Forest Act. And yes, to the point that Kenneth just made, we don't want to spend so much money on massive open areas for small gain. There's certain things that nature will help maintain as well. But when we focus on investment, particularly around critical watersheds, those that are really going to butt up against our communities, that's where some of that investment might be targeted through, data-driven planning, et cetera, where is the most effective places to put those field treatments on. But as we do those field treatments, as we do improve the health of our forests over time, from an insurance standpoint, again, we're invested in this because there is a benefit to insurance. It does reduce the risk of these fires leaving the natural lands and coming into that built environment. And so, yes, catastrophe models and insurance pricing does generally reflect a lot of that as we remove fuels that are otherwise going to be a high hazard to these communities that are either within them or butting up against to these natural wildland areas.
Yeah, and I think somebody mentioned before, and I can't remember who, about this idea of not building in high-risk areas. And, I kind of want to flip at that a little bit and say, okay, we know an area is high risk. What do you need to do to reduce the risk in building in that area? Because in some cases, we don't have a lot of choice. When a city's expanding, where are you going to put people? And, obviously, people are the most important resource on the planet. So I think part of the code discussion and part of the IBHS and the insurance industry is going to be defining, hey, we'll insure you if you do this, 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 and this. Not getting to the point where we say, we're not going to insure you because you're building here. Which I think is more of a positive approach. I'm way more in favor of carrots than sticks. Anyway, that's just my thought. James, you had a comment.
Yeah. And I think it comes back to what you're talking about, like the WUI is what they call it, the sort of wildfire, like the wildland urban interface. And I think to your point, I think government and the private sector have to work together, property owners and but I think this whole concept, and this is coming back to the concept of standards, right? Because we need to understand what people are doing. Like if the insurance industry is going to give value to people improving, like more than one person has to do it, and we need to make sure that we're verifying what we're doing. So at the Resiliency Company, like what we're trying to do is like we help spin out a piece of technology that would make it really simple to verify around like plan review. And to the point on Karen, a lot of people have made rebuilding is way less expensive than doing it later. But at the same time, like we're seeing massive resiliency gaps. And so, or gaps in the rebuild because of inflation and labor. So we end up with this thing called the resiliency gap, which is the gap even above the rebuild to make it more resilient. So we're focusing on that. Like, how do we actually incentivize people to like do that but we want to do it to a standard because for us to see, I believe, our theory is that to do this takes so much money that this is not government's responsibility solely. This is a lot of times homeowners' responsibility. Like, you think you have equity in it, but do you really have equity if it's not there anymore? And so, and homeowners are finding the answer is they have a lot less equity than they think post-disaster. And so these are things but it's around the standards that like we're very much with IBHS and looking at defined measures, the fortified also of IBHS, defined. The California Insurance Commissioner put out a report on how much it is, reduction of risk if all the homes had been up to that standard. So, but it's again, homeowners can't do things beyond their property. They can't do things into the forest that's beyond them. But this is where we all have to work together. And how can we use data to understand what our risk is? Then assign sort of different sort of value streams and who's responsible for what, but how can we then work together? And like the answer is though, the present value, as I said about Lahaina earlier, when a whole home community burns down, all the tax revenue goes with it. And so and the trauma for those communities that have gone through this is enormous. And so we investing in this from an emotional perspective, but also from a cost perspective, is a really important factor, but doing it in a methodical fashion. That's why we're also starting to work, and this is through the Government Finance Officers Association at the Resiliency Company, which works obviously in Canada and the United States on projects where we can work with state and local governments and beginning to identify risk on balance sheets for them and understand mechanics and how that. So we're obviously very focused on the finance side, but we also think finance can unlock the ability to do it so that we can think longer. Hey, this is a 10-year payback from insurance savings. If you pay for this, great, take out a 10-year loan to do it. Like there's also ways to think about using models of finance to match up with where we can see benefit. So and I think the luxury in the United States is, frankly, I feel fortunate to have access to all these financial tools but we just have to direct them, and we don't need to reinvent any new ones. We just need to use the ones that we have, like home equity lines of credit or local credit unions and CDFIs and lenders, green banks, all these folks that have, and especially in the Northwest, where I think there's a lot of resources to focus, but it's aligning benefits and resources together.
There's another question here, and they're kind of related to some other questions about, how do you create the business case or the return on investment? And, for new construction, it's probably much easier, especially for a homeowner or a business owner who's taking a loan to build a building, or, even government who is basically issuing bonds to build a structure. The additional cost of $5,000, let's just say, for a 30-year mortgage, I know that's different in Canada, but is probably, achievable, right? For most people. But $5,000 to improve an existing home for most people is probably not achievable, right? You just don't have $5,000 to improve your roof, or even when it comes time to fix your roof, when you're forced to do it. Well, a lot of people don't even have money for that. But are they going to spend $20,000 instead of $15,000? So part of, I think, our mission would be to somehow develop the ROI, plus, obviously financing, because, if you have to get a personal loan or, second mortgage just to make those improvements, probably not going to happen. Paula, did you have a point about that?
I think we need to differentiate between individual homeowners and large public infrastructure. I mean, individual homeowners will have to make those decisions themselves. But I had a quick peek at some of the questions in Huva. I have to tell you, there is no way that you can build a house to withstand a wildfire. I don't care what you build it out of. If wildfire sweeps through the community, micro risk is not what the reports that I've worked on have been about. It's about macro risk. How do we protect communities? Here in Edmonton today, I have to say, I'm sort of embarrassed. This is the first day we've had really bad wildfire smoke. It's been very wet all summer. We've mostly had rainstorms and mosquitoes. Today we have smoke. Today I heard on the radio that the city of Edmonton is opening up and telling people to go to public libraries in order to be able to breathe. That's lovely. How many of our public libraries actually have the right air handling to provide any more protection than people's houses do? We need to be thinking bigger than fixing your roof against hail. That is, at the end of the day, your responsibility. The responsibility of government and community is to figure out how we make resilient communities. And that is going to involve investment in public infrastructure that will serve the public good.
Yeah, I mean, I understand that, but, again, and maybe it's different in Canada, I suspect not. that when a disaster does happen, when hail happens, let's say it's usually not just one house, right? It's a whole community that gets destroyed, and it's even worse with hurricanes and wildfires and everything else. And what happens is that you and I, everybody here, pays for that, right? We pay for the recovery. It's not every single homeowner that pays, yeah, okay, they have insurance, they get paid for it, but now the insurance goes up. Or the entire community has to recover from that because guess what? People have to move out for a while. It means tax base, starts to decrease and all that.
I mean, as I said in my opening, this summer alone in Edmonton, we've had $230 million insurance claims. And this is primarily for individually minor things, individually flooded basements, individually damaged roofs. There aren't tens of thousands of unhoused people in Edmonton because of these storms. There are many tens of thousands of people who have been massively inconvenienced. And you're right, that raises insurance rates for everybody. When there's hail and there's government payouts, that raises the cost for everybody. I guess what I'm saying is that I hope that this working group will have the vision to think beyond how we make our individual castles safe and to think about how we build in resilience fundamentally.
Right.
I mean, what would make our houses flood less is if we had better storm sewers, and no individual homeowner can pay for that.
But don't we already pay for that?
But the one, oh, sorry, go ahead, Karen.
I'm going to have to end it there. I'm sorry, we could go on for a long time, and we will, because after this session, the real work of the working group begins. And I apologize that you guys had comments, but maybe you guys will be part of the working group and help us solve these things. And so I just want to join me in thanking our panelists. I thought they did a great job. Please give them a round of applause. Obviously, their insights are going to help fuel the work that we're going to be doing in the working group. And I'm glad I had a lot of questions from the audience. I didn't get a chance to get to all of them, and I apologize for that. But we will make sure that we have we'll take these questions and bring them to the working group to see if we can answer them for sure. Brandy, would you make the just final remarks, or do you would like me to make final remarks with regards to what the next steps are?
Your call. Would you like me to do it, or would you like
Yeah,
to?
go ahead.
Okay. So thank you everybody for being here. Our next meeting is going to be sometime in September. There will be information going out to anybody who's already tied into the working group. And if you're not, or you haven't confirmed yet, please still reach out, because the more the merrier. So what we'll be doing in the meantime is pulling together information, starting to identify priorities, figuring out who we need to hear from, and developing a plan to go forward so that we can actually start to get things done. Because, as mentioned multiple times, this is not sexy work, but it kind of is. It just depends on what you consider sexy. So,
My orientation is infrastructure.
there you go. So, again, thank you everybody for being here. Penwar staff, thank you for all the work that you do. And if I missed anything, go for it.
Yeah, no, I agree. Thank you so much. We'll, for those who are on the working group, we're going to begin to gather input. You're going to be shaped into the different panels, obviously. And, because we're a working group that encompasses those three panels, we will be able to cross-pollinate with one another. That's going to be a challenge, obviously, but, so you don't have to be necessarily volunteering for all three panels because you want to be involved in all three. I think you focus on a single panel and get work done there, and then we'll figure out a way to cross-pollinate, and we'll develop the work program. But thank you so much. Thank you for Penwar for putting this together, and looking forward to working with all of you. Thank you.